Hi and welcome. In this video, I wanted to talk about something very important, which we have seen, especially when dealing with startups and SMEs, especially here in South Africa. And I wanted to touch on a topic that is cash flow versus profit, and why profitable businesses, even if they are startups, still fail. So cash flow versus profit, and why profitable businesses still fail. So we are talking about small and medium enterprises and startups. There are startups that could be profitable, very good, and a very serious business model, but they still fail even if they've got a good business model. And one of the main reasons is really the management of cash flow and profit, and that sometimes business owners do not seem to understand, or directors or entrepreneurs do not seem to manage this very well, or do not seem to understand this very well. So many business owners are shocked when their business is profitable on paper, yet they constantly struggle to pay suppliers salaries, or SARS, or any other payments that may come due. So this confusion usually comes from not understanding the difference between profits and cash flow. So we are going to talk about this practically, because misunderstanding this concept is one of the biggest reasons businesses fail, especially here in South Africa, even when sales are looking good. So when your revenue is actually looking good. Now here at TFS Consultants, we see this problem regularly, and business owners proudly tell us that they are making money, but at the same time they are behind on their rent, behind on their supplier payments, behind on their payee payments, behind on their VAT if they are registered for VAT. And the issue is not always poor sales or poor revenue, but it is often poor cash flow management. Now let's start with profit, and we need to understand what profit is. We're going to talk about it on a layman's terms. So profit is an accounting concept. It is calculated by taking your income, which means all your revenue, the money that you are making from your sales, or from trading in your business, and subtracting your expenses, which means your business expenses, the expenses that you're incurring in operating your business, and then so all those expenses for that period, you are subtracting them from that income. Now if income is higher than expenses, you show a profit, and even your balance sheet or your financial statements, your income statement, will show a profit. And this is what appears on your income statement. Profit tells you whether your business model in general is working in theory, but it does not tell you whether you actually have money in the bank. You will know usually what is there in the bank and what is showing on the profit statement is totally different things. So cash flow, on the other hand, is about timing. Now it looks at when monetary or when money actually comes into your bank account, or into the business bank account, and when money actually leaves the business bank account. So cash flow answers a very simple but critical question: can your business pay its obligations as they come due? That's what cash flow is about. So paying your obligations as they come due. And on the other hand, profit just shows all your income and your expenses. Now we're going to look at where the problem is. So here is where the business get it wrong or get in trouble. So you may issue an invoice today because you have done some services, or you have sold your products, and you record it as income in your profit and loss calculation. Now, and this increases your profit. When you recognize this as your income, it increases your profit. But if the client is only going to pay in 30 or 60 or 90 days, depending on your receivables or receivables policy. Now, the cash is not yet available in your business. You have not been paid. Although you have recognized that you have sold something, which is you have got an invoice that you prove that, no, I have invoiced this, I'm still waiting for payment. And if your payment terms are saying in 30 days or in 60 days or 90 days, what you only have is an invoice. And in your accounting books, you would have recognized already an income, but the money has not actually come in your bank account, which is the cash flow part, has not actually happened. So, and at the same time, you still need to pay your rent, you still need to pay your staff, you still need to pay your suppliers and SARS or whatever your normal day-to-day applications, expenses and things like that. Now, on paper, you are profitable, but in reality, your bank account is under pressure. So, adding on to that, another common example is your inventory. If you are a business that's running an inventory or stock, so when you buy stock, cash leaves your business immediately because you have purchased that stock. Now, however, the expense only appears in your profit calculation once the stock is sold. So you have stock that you have purchased, you won't recognize the expense actually in your profit statement up until that stock is sold. That's when you recognize your revenue and your cost of sales. That's what's going to happen in your profit and loss. Otherwise, when you purchase it, the stock only shows there as part of your assets, as part of your current assets, is inventory. So it will only go into the profit statement once it is actually sold. Now, this means cash flow takes a hit long before profit reflects the cost in your income statement. Business that grow quickly often suffer from this problem, especially with stock. They need more stock, and more staff and more resources before the cash from the sales actually come in. And you see now that there is a problem, or there is a mismatch between what's happening on profit and what's happening in your cash management or cash planning. These are two different things that's happening. Now, another area is also the tax part, especially if you are VAT registered or not. So, VAT and provisional taxes are based on income. So the income that you have earned from your sales, or the income that you have invoiced. Remember, a VAT is the area of income, of cash or invoice. So if you are not setting aside cash for tax, you may find yourself owing SARS money that you do not have, or you have not received, or you no longer have. This is one of the fastest ways to push a profitable business into financial distress. So if these two things are not managed well, especially when it's a startup or when it's a small business, then the business will fail. It may take a bit of few months or a few years, but it will eventually fail. So how do you manage this properly? So the cash and the profits, how do you manage this properly? So the first step is to track cash flow separately from profit. So the same way you are also tracking your income and expenses, the same way you would have to track also your cash flow and manage it properly. So every business, no matter how small, should have a basic cash flow forecast. This is a simple projection showing expected cash inflows. So we're talking about money that is actually coming, not anticipated. And also cash outflows over usually for the next 3 to 6 months. So it should be a projection of what you think is going to come in terms of actual money, and what is going to come out of the business or go out of the business for the next 3 or 6 months. This allows you to see potential shortfalls before they become crises in your business. The second step is to manage your receivables aggressively. So you should have a receivables policy. Invoicing promptly, following up on late payments, and setting clear terms. All these will improve cash flow without increasing the sales. So you're just going to make sure that you are collecting all that you have invoiced, you are collecting it on time or earlier. So you have to have better policies that make sure that your business is actually getting the money quickly than the money they actually pay. So your receivables should be shorter. Actually, receivable days should be much shorter than your payment days. So thirdly, expenses should be timely or timed strategically. Where possible, match the large cash flows or cash outflows with periods when you expect strong inflows. Now, this includes negotiating payment terms with suppliers and avoiding unnecessary upfront commitments. It is also important to separate business and personal finances, especially for startups and for small businesses. Obviously, the directors are usually linked to how the business is operating. So it's very important to separate business transactions into the business account and your personal transactions in your personal account. So drawing too much money from the business because it looks profitable can actually drain the cash that is needed for your operations. So profit does not mean available cash. These are two different things. And here at TFS Consultants, we always advise clients to stop relying on bank balances alone as an indicator of your business success or business succeeding. A healthy business understands both profit and cash flow and manages them together. So profit keeps your business viable in the long term, and cash flow keeps it alive in the short term. Profit is important. Both these things are important. Profit shows your business model is working properly in the long term, but the cash flow now helps you to make sure that as your expenses and your obligations, your liabilities are needed to be paid, you are meeting those obligations in the short term as your business is going. So the reality is this also, businesses do not fail because they are unprofitable. Most cases they fail because they run out of cash. Once you understand this difference and start managing it, especially managing your profit and cash intentionally, you place your business in a much stronger position to grow sustainably and meet its obligations. So this is what I wanted to discuss, and I always see that when I deal with directors, especially of small companies, there's a struggle on managing these two, separating their own personal expenses from the business expenses, having their personal affairs happening in their personal bank accounts, and having business affairs happening in business bank accounts, and having to manage profits and expenses. When you do their profit statements and stuff, they will think, no, we have got too much money here, even the bank account, even when the bank account is almost zero. So it is important. Now, if you find this explanation or this discussion helpful, this is exactly the type of practical accounting guidance that we share here at TFS Consultants. And understanding numbers behind your business is not optional. It is actually essential. It will help your business grow, and you will be basing your decisions on the actual numbers that you are getting in your business. Thank you, and please subscribe to this channel and look into the other videos that we have that you find helpful, especially if you're a small business owner. Bye.